Hello everyone, welcome back to my channel. Today I want to talk about a different topic because I believe this is a quite significant development in the financial industry, and I don't think it has received the public attention or the media attention that it deserves. I wanted to make this video for some days because, as most of my followers know, I'm very interested in the topic of ESG, also its role in the finance industry, and I believe that its underlying practices have the potential to completely transform how the industry, meaning the finance industry, and the economy as a whole can evolve in not only for the short term but also in the coming future for the long term. And so that being said, I am still very realistic about the fact that such considerable changes need to take some time to settle in and properly uh, become commonplace among the economic agents and markets worldwide. Otherwise, if we try to force the transition into more sustainable practices, I think not only economic agents will do some pushback, will resist the change, and become opponents of ESG, as we are seeing in many countries worldwide. But also the entities that provide investment services will have a greater incentive to bring forward investment options that claim to be consistent with ESG practice when they are not. You see, and so uh, what this basically is the greenwashing concept, which is by putting it very simply to you guys, is the attempt by a business or an investment vehicle to claim that it is compliant with several ESG standards or practices when in fact it is not, but it misleads investors and other economic agents that it is something when in fact it is not. And so in this context, the Financial Times newspaper published a story back in January 10th, which states that several high profile fund managers, including Morgan Stanley and the UBS, have been launching fewer investment funds based on ESG factors. Those are so-called ESG based funds, and also removed ESG labels from several of its funds names, the fund denominations. And so, in particular, the newspaper says that according to Morningstar, over the past, I believe, over the past 6 years, more than 120 funds have been either renamed or being given updated strategies to become consistent with ESG. This is a clear sign that these funds were not clear in terms of their intentions or in terms of the assets they invest, their strategies. They were not consistent with ESG as they should be, given probably their names or their fund perspectives. And so this is also a form of greenwashing. And so not only that, but you see the impacts of this happening, most likely because of investor scrutiny, also regulator scrutiny as well. Not only that, but only six ESG funds were launched in the second half of 2023, compared with, I believe those were around 50 or 55 in the first half of 2023, and also an average annual launch of ESG funds of about 100 between 2020 and 2022 in this three year span. And so, as I said, this development is likely to come as a response to the tighter due diligence and scrutiny by investors and also by regulators themselves. Just to give you an example, in last September, if memory serves me right, the SEC, the Securities and Exchange Commission, which is the main regulator for the financial markets back in the United States, introduced a new rule for investment funds, in which it mandates that funds must have at least 80% of their assets invested according to their names or to their labels. And so this leaves a much narrower scope for diversifying portfolios beyond the strategy that is purported or the name. And so if ESG funds, if a fund claims to follow ESG practices, this means that at least 80% of the assets invested must serve some sort of some way of sustainability, some sustainability purpose. And so with this requirement in place, the scope for greenwashing is much narrower, and so this also leaves fund managers much more restricted in this regard. And so as a result from these developments, it is my opinion that there are several factors that may prevent a larger allocation of capital to ESG funds, at least for the time being. And so, first of all, I think the main factor is that the pool of investable assets in the context of ESG, mainly the assets that serve some sort of sustainability purpose, this pool will continue to be small enough to prevent the entire fund industry from launching a larger number of ESG funds, relative, of course, to the amount of capital that wishes to be allocated to these sort of funds and these sort of assets. And so, otherwise, they would, because if they don't do that, they would be committing, of course, greenwashing. And why is that? Because why is the pool is so relatively small in comparison with the amount of capital that wants to invest in those assets? I would say, but this is just my opinion, of course, it's on me, this claim. I believe that many of these ESG assets incorporate cutting edge technology that is still expensive and is yet to become widely available. And so, because of course the cost is so high at this particular moment in time. And so as a result, the cost of investment on one hand and the cost of ownership on the other hand of those assets is very high, and its lack of widespread adoption relative to other conventional assets. I'm thinking about at this moment with assets in the energy sector, all right? This difference in terms of cost is what I believe prevents some ESG assets from yielding the returns required by investors, not only in terms of the size of the returns, but also in terms of the volatility of the returns, for these investments in ESG assets to be worthwhile in the eyes of investors. And so, on the other hand, I believe that from the investor's perspective, there is no two ways about it. It is a fact that most investors still prioritize returns above everything else. Today, I have a very strong feeling about this, is that if given the option for an investor between having a specific rate of return and basically compromising a little bit on the return and or some of the return and having the upside of investing in an asset which serves a sustainability purpose, I believe that most investors still prefer to prioritize returns above everything else. And so in many cases, ESG considerations take a back seat when it comes to investors' the decisions. And so bearing this in mind, and given that many ESG funds have underperformed traditional funds back if we look at 2022 and 2023, it was not the case before that, but in 2022 and 2023, ESG funds have underperformed traditional funds. A significant number of investors have been more reluctant to invest in the ESG funds, also because of the risk of investing in a fund, in an investment fund, which ends up not or ends up being found out that it was not investing in any sort of ESG type of assets. And so, in light of this situation, I believe the solution to bring ESG to the top of investors' priorities lies first and foremost in investment, in research and development, R&D. That will make the resources and technology used in the creation and, of course, the maintenance of ESG assets cheaper on one hand, and on the other hand, more widely adopted across nations to the extent of being able to potentially render non-ESG assets obsolete. For the biggest example that comes to mind is non-renewable and more pollutant energy sources, and so the replacement of these assets by assets which are able to generate energy through renewable sources. This is something that it needs to have some sort of further research and development in order to be able to completely replace these non-ESG assets that generate more pollutant type of energy. And so by taking the place of non-ESG assets across value chains worldwide, ESG assets will be able to yield higher returns because, of course, the demand for the output that they produce would be much higher, and because it will be more wide, their adoption would be wider spread over, of course, a wider range of jurisdictions. The volatility in terms of their usage will be much lower, and this, I believe, it's a combination that will attract a much larger group of investors to allocate their capital. And so, basically, this is what I had for you today, guys. I believe that, of course, ESG has still a long way to go. I believe it's here to stay, but it's important not to overhype this particular acronym or this particular concept, because the potential is there, but there's still a lot of steps to be done. The transition must be made in a gradual manner. We cannot force it, because otherwise there's going to be a huge cost for more vulnerable populations around the world. And even among those people who are not as vulnerable, there will be a lot of resistance. So this is some sort of momentum that needs to be built gradually. I know that climate change, at least this is my opinion, of course, is an emergency that needs to be addressed sooner rather than later. But still, in order not to jeopardize the entire purpose, it's important to put it into play gradually and to make sure that investors, because these are the people who will enable and will unlock the potential of ESG, it's important that them have the confidence and the trust to be able to invest in these sort of assets, because at the end of the day, without their capital, this sort of transition will not be possible. And there's no two ways about it. And so because of that, it's important, quote unquote, to treat them right, to respect their capital, to make sure we fulfill the promises when it comes to returns and in terms of risk that they will be partaking. It's important to keep hold of these promises, not selling like unrealistic dreams or ambitions or return profiles, because at the end of the day, that will not going to work out. And so it's important for them to allow, as much as we can, investors to invest in these sort of assets, to make sure that this transition is made even if it's a little bit slower way, in a more sustainable way, to make sure this transition is fully completed in due time before, of course, the conditions of the earth we're living in becomes untenable for its population. And so basically, yeah, that's what I wanted to tell you guys today. Feel free, of course, to leave your comments below. What do you think about this? Any aspects that you would like for me to address a little bit more deeply? Of course, like the video, subscribe also as well, and as always, I will be available on LinkedIn if you have any questions. Thank you so much for you guys, and until the next video. Thank you.